Start your day with It's the Business. Here's Phil Dobbie.
Well, today, Jasmine Birtles joins me to talk money, specifically your money. What should you do with it?
What is the fundamental difference between saving and investing? And the answer is time. So time is the big difference between saving and investing. Saving is short term, investing is long term.
And those investing in government bonds all of a sudden seem to be bailing out. Well, to an extent anyway. We'll look at why money markets have got so excited, particularly over bond yields, even though the governor of the US Federal Reserve is trying to keep the waters calm.
So while you could see prices move up, that's a different thing from persistent high inflation, which we do not expect. And if we do get it, then we have the tools to deal with it.
Yes, there's been a big spike in bond yields around the world. All this is because of the fuss over the differing views of money supply. Central banks aren't concerned about money being created to cope with the pandemic. Others have a different view.
I'm not sure that the top leadership of the current government really has that appetite for being unpopular in order to do the right thing.
Yeah, remember Philip Hammond? Well, he certainly knew how to be unpopular. Whether he did the right thing or not, that's open to debate. We'll look at the whole question today of money supply and bond yields. I'll take you through it step by step. And Mr. Potato Head, he's gone woke. Is there no end to this wokedom? It's Friday, the 26th of February, 2021. Good morning.
And now, it's the business, making sense of it all with Phil Dobbie.
Yes, the disappearance of Mr. Potato Head, that is just one woke too far as I'm concerned. We'll look at that later on. But first of all, there are interesting things going on in the world money markets, particularly when it comes to government bonds, and a lot of people are getting excited about it, overexcited about it. I'd suggest, I'll explain why in just a second, but let's have a look at the way this works, just so we're all on the same page. I know a lot of you will get this, but I'll try and explain in as simple terms as I can what's been happening over the last 24 hours. It's all to do with government bonds. Now, government bonds are issued, strangely enough, by the government all over the world. But the interest has been in the United States, but it's been a little bit contagious to other countries, in particular places like Australia, less so the UK. Government bonds pay interest at a predetermined rate. And obviously right now interest rates are very low. So new bonds issued are issuing bonds paying very little back in terms of interest each month. And it's likely, with this stimulus package that Joe Biden is trying to push through over the next week or so in the United States, there's going to be another $1.9 trillion worth, yes, $1 trillion of government bonds issued to cover all this new debt that the government is going to create at record low interest rates. But when bonds are sold, the coupon, the amount of interest that is paid, remains the same. So if the price of the bond falls, the interest payment is higher as a percentage of the cost of the bond. This is what's called the yield, rather than calling it the interest rate, because the yield changes depending on the price. So if you buy a bond for $10 and it pays out $1 a year, that's a 10% yield. If you then want to get rid of it and you have to drop the price and you sell it for $5, the person who buys it still gets that $1 a year. So the yield now is 20%. That's the way it works. Of course, yields are much smaller than that, and the moves are much slower, but that's the way it works. And yields have stayed low during this crisis, and before actually, because prices haven't been falling, because people don't want to get shot of their bonds because of all the uncertainty that's been around, even before COVID. And there is a concern that this is changing now. But look, when there isn't the high demand for bonds, central banks buy up the bonds. That's the way they keep interest rates low. They just lower the amount that's available in the general public pool in what's called the secondary market. Because the central bank doesn't want a big difference between the official interest rate that they have determined and the interest rate paid on bonds. So they control the amount of bonds in circulation by buying up a chunk of them. And they've been buying an enormous percentage of them. More than half of all bonds issued are being bought up by central banks around the world. So we've got loads of new money coming in the form of these bonds being issued, but still low interest rates. And that's been the way until this month, and in particular yesterday, which is why everyone's getting very excited, because now all of a sudden people have started selling off their bonds. And the interest, or the yield, I should say, on US 10-year treasuries, the bonds issued by the US government, this month has gone from less than 1.1% to almost 1.5%. More significantly, 2-year bonds that means basically you'll get paid back in a shorter time period. The interest rate there has gone from 0.6% to 0.8% in a day. So 2-year bonds, 10-year bonds, basically when the government issues these bonds, it's got various durations that it issues them for, how quickly you're going to get your money back. So if you can go 2, 10, 30, for example. So these numbers seem small, from 0.6% to 0.8% in a day for 2-year bonds. But these are actually quite big moves. And the reason why the short-term bond rise is interesting is because that tends to mean investors are expecting inflation. Now, if you buy 30-year bonds, you've probably factored in that inflation will go up and down because it's 3 decades. It's going to go up and down at some point. But if you're buying those shorter duration bonds, what happens next, what happens this year, is very important to you. So if you see inflation coming, then you know, and if the inflation is very high, then the value of your bonds will drop because things lose value as prices go up. So you'll try and sell them off. That's going to make the price drop and the yield goes up. And a lot of investors did that yesterday. So clearly, a lot of them think inflation is happening. Now, this is happening despite the fact that Jerome Powell, the chair of the US Central Bank, the Fed, is denying inflation is on the way. He's saying this every day at the moment, it seems. He's saying we might see some inflation in the short term as the recovery takes shape, but it's not going to be sustained inflation. Here he is yesterday saying it again at the House Committee on Financial Services.
I would just say that we do expect inflation to move up, both because of base effects, as I discussed yesterday, and also because we could have a surge in spending as the economy reopens. We don't expect that to be a persistent, longer-term force. So while you could see prices move up, that's a different thing from persistent high inflation, which we do not expect. And if we do get it, then we have the tools to deal with it.
The reason why there is all this inflation talk right now, I think Elon Musk has a bit to do with this, because he's been talking about Bitcoin, and Bitcoin owners use the argument that Bitcoin is the only thing that's going to retain its value because it's a scarce resource, whereas money is printed, and if you print more money, then they reckon that makes money, all the existing money, lose value. And this is all because we've spent too much time listening to Milton Friedman in the 1970s. He did argue that if you increase the supply of money, every pound or dollar in existence is going to be worth less as a result. So you get inflation resulting from that. Even though if you look at Japan, they've been printing money like crazy, and they've had prolonged periods of low inflation or deflation even. So that sort of disproves Milton Friedman's work if you use this thing called evidence. So it's just possible Milton Friedman, the father of austerity, was wrong, and perhaps we should stop listening to him. But Jerome Powell was asked this question yesterday, whether money is losing its value as the money supply, the M2 measure. It's different ways of measuring it, but basically the more liquid money has gone up by 25% in 1 year. Is that going to diminish the value of the US dollar? Well, no, says Jerome Powell. Doesn't look like it.
You know, there was a time when monetary aggregates were important determinants of inflation. And that has not been the case for a long time. So you'll see, if you look back, the correlation between movements in different aggregates, you mentioned M2, and inflation is just very, very low. And you see that now, where inflation is at 1.4% for this year. Inflation dynamics evolve over time, but they don't tend to change overnight. And so we've had, and I remember well, I was in college during the 1970s. I remember well high inflation and this feeling of powerlessness on the part of anyone to deal with it, until finally Paul Volcker did exactly that. And we've been in a low inflation, disinflationary mode ever since. So what I see is an economy where there's still a great deal of slack. I see the prospect of really significant progress as we put the pandemic behind us. As we see that data, we've got in place guidance that tells markets clearly when we will begin to taper asset purchases and when we will begin to raise interest rates, when the economy, in that case, when the expansion is very far advanced. So we have our tools, we have them in place, And we think that this is the appropriate policy stance.
I think it's all going to die down, isn't it? He's basically saying inflation is going to be short-lived. It's going to be related to the rebound of the economy, hopefully. I mean, there will be other factors that are pushing prices up right now to do with the supply chain. So things are hard to get, so they become a little bit more expensive. And if they contribute to the value of something that's getting sold down the track, then that's going to push those retail prices up. But the real determinant of inflation is jobs. If lots of people are looking for work, it makes it very hard if you've got a job to ask for a wage rise, doesn't it? Particularly now, unions are largely a thing of the past. Particularly now, so many people are working in the gig economy, underpaid, which is not good, but it does prevent inflation from getting out of hand. And if it does start to rise, if we do start to see inflation pick up, then Jerome Powell says then they'll just push up interest rates. Simples. And things will settle down, I'm sure, even if those bond yields keep rising. And we've got to get some perspective on this, because even on those 2-year yields in the United States at 0.76%, at the start of 2020, they were at 1.7%. Midway through 2018, they were over 3%. We didn't get inflation then, but still it may happen this time, mightn't it? Buy Bitcoin. Buy Bitcoin. Not. In the UK, by the way, 10-year gilts are at 0.79%. The bonds issued by the UK government, 0.79%, pretty much where they were before the pandemic, before Rishi Sunak started spending big, or biggish. I suspect he's going to have to spend a lot more before all of this is over. Although Philip Hammond, you know him, remember him? Dr. Austerity. He says the government is just giving money away. He wants to return to the good old days of holding money back. Well, we won't have inflation, will we, if we do that? Yeah, because we didn't have inflation when he was at number 11. But we also didn't have economic growth. Here he is on the BBC yesterday.
I'm very confident that the Chancellor's instincts are the right ones, but he's part of a government, and that government has made very extravagant commitments to the British electorate in good faith before the coronavirus crisis. Not all of those commitments can now sensibly be delivered on, and that's going to be a big challenge for a government that regards its short-term popularity as very, very important. After 2010, we always knew that we were going to go through a period of intense unpopularity as we implemented the measures that needed to be taken. I'm not sure that the top leadership of the current government really has that appetite for being unpopular in order to do the right thing.
No, so if you are unpopular, you must be doing the right thing. I think that is his argument there. He's going to be very disappointed, isn't he? Because the government is pushing on with the spending plans to level up the economy, although how much of it is tokenism, we'll yet to see, because well, the government announced yesterday that they were extending the Levelling Up Fund to £4.8 billion. That's up from £4 billion, which they'd already said. So, and they're saying this is going to be invested in local projects such as regeneration and transport, ensuring the government provides the same support to communities across the UK as we build back better from COVID. That's the best I can do of Boris Johnson. But mind you, from 4.8 billion, from 4 billion, I should say, to 4.8 billion. Let's get some perspective on that. They spent 280 billion so far on the economic support package. They want to spend an extra 0.8 billion on levelling up. That is a pretty small percentage, isn't it? No big shakes there. Meanwhile, the US is pushing on with a further stimulus of what amounts to £1.3 billion, $1.8 billion. 5 times what we've spent so far, they're spending in their next round. And Biden is talking about perhaps doing more further down the track as well. So if it is an experiment on the impact of creating new money, we're going to have to see who wins. Biden's spending spree or Philip Hammond's fiscal conservatism channeled through Rishi Sunak, perhaps, because they've all read Milton Friedman and then they stopped reading. They've closed their minds since then. So what is happening right now is we are by default moving to the argument made by modern monetary theorists. If you create enough money, then you will create jobs. And when you have those jobs, then the private sector is functioning all by itself. You need less government money. So basically, when the private sector is struggling, there's nothing new about this. This is Keynesian economics, isn't it, really? It stands to reason. Charlie Munger is a veteran investor in the United States. And when I say veteran, he's 97. He is the vice chair of Warren Buffett's company, Berkshire Hathaway. He's a billionaire, of course. Here he is yesterday answering questions from their investors. He was asked what he thought about modern monetary theory, and he didn't really have an answer.
Well, modern monetary theory means the people are less worried about an inflationary disaster like Weimar Germany from government printing of money and spending it. And that's monetary money. Modern
monetary theory.
So far, the evidence would be that maybe the modern monetary theory is right. Put me down as skeptical. I don't know the answer.
We do have right after 97 years. Even he doesn't know what's going to happen next. It shows what interesting times we're in. But the other issue he went on to say, by the way, he was asked whether he was concerned about the rich-poor gap increasing during the crisis, and his answer to that was, well, the rich can't get rich without the poor getting poorer. So there we are. And if he doesn't know after 97 years, these are interesting times. Boris Johnson, if he wants to retain his seats in the north, is going to need to level up, isn't he? As he said he's going to. And he's going to have to spend to do that, which means he is going to have to create more money. So we'll watch with interest to see what happens over the next year. Fascinating stuff. But you and I can't create money, of course. It's illegal. So please don't try that at home, children. But some of us don't need to. Some of us have actually saved through the COVID crisis. If you've kept your job, then you might actually, in fact, be better off. A number of us supposedly have saved during the lockdown. Collectively, consumers paid off £16.6 billion last year. Obviously, a very different story for businesses who went the other way and are now in greater debt. And the household savings ratio, our savings as a proportion of disposable income, went from 7.7% in Q4 2019 to 27.4% in Q2 2020. The Bank of England governor has called it the coiled spring that is ready to bounce back as we dip into those savings and start spending again, if we ignore the fact that many of us also have huge debts. But, I suspect that there will be a reluctance to shop too quickly and to shop excessively. We might also be reluctant to go off on many holidays as well. And those of us who have kept jobs through all of this, we could find ourselves with a bit of extra cash and not sure what to do with it if we don't want to spend it. Money that could be sitting in our bank accounts doing very little. So what do we do with it? Well, we ask Jasmine Birtles. That's what. She is the founder of Money Magpie. She is also the author of 38 books. 38 on money. She's with us now. So do you reckon this is the case, that there is a bit of money swilling around and it is just sitting in bank accounts doing nothing at the moment?
Yeah, there certainly is. It is. I mean, just momentarily, we could look at the whole picture. On the one hand, as you say, there are huge amounts. There's huge amounts of money that people have in their savings. There are, at the same time, though, of course, a lot of people who've gone worse during the pandemic.
Yeah, absolutely.
Just before, apparently, there were about 10.2 million people with no financial resilience. Now the February figures are that it's 14.7 with none. So yeah, it has really polarized society even more. I think the haves have much more. I mean, we look at the big tech. God, they've done well out of it. But a lot of people haven't. But yes, you're absolutely right. There are so many people who have managed to pay off their debts, have paid off the credit card bill, they've paid off the overdraft, and now they've got savings, and that's making nothing in the bank. And they're wondering what to do with it.
Mine is doing nothing at all because I have got a bit of spare cash and I've put it on premium bonds, which I'm shocked as it obviously gives me no interest whatsoever. And I'm shocked to say I've not won anything either. So maybe that's not such a good idea, but perhaps a little bit just to give you a bit of hope that maybe you'll win $1 million at some point. Well,
absolutely. That is the idea with premium bonds. If you look at the average return with premium bonds on the whole, pretty much every year, it averages out at whatever is the current savings rate. So on the whole, and unless you do, as you say, unless you win something major, and I have come across a few people go, I win 50 quid every month, good for them. But on the whole, the return, if you sort of average it out, it's frankly not very much more, might be just around about the same as ordinary savings accounts. So I tend to say, I mean, it's not something that's ever been of interest to me. And I tend to say to people, well, if it stops you having a flutter on the GGs or something like that, then great, do that. But that would be the only reason that I personally.
Yeah, exactly. Yeah, absolutely. So, so I should pull it out and do something useful with it. And you're going to tell me what to do. So, obviously, the first thing to do is paying off debt, which you've already mentioned, which, I mean, could mean paying off more of your mortgage. Although, with interest rates so low, perhaps there's less incentive to do that right now.
Very good point. Yes. I mean, I'm a big fan of paying off your mortgage as fast as possible. But as you say, interest rates are so low. And some people have got... I have a friend who has a mortgage that's 0.75% over base rate. And if base rate is 0.1%, you're paying practically nothing. So there is a strong argument to say, well, just leave it there. However, there are big advantages. Firstly, it's probably the safest investment that you can make, because with anything else, of course, with savings accounts, as you know, the first £85,000 of your money is protected by the Financial Services Compensation Scheme. So if that bank or savings account falls, you can go back. You will get the money back. But above that, it's not covered. And also with when you're paying off your mortgage, you pay off your mortgage. That is it. But also it's a tax-free saving, because when you put money into your mortgage, the HMRC doesn't see it as saving or making money. They see it as paying off a debt, which is what it is. So you don't have to pay any tax on that. Whereas with some savings, you would. Of course, with a lot of savings accounts, you don't. For many people at the moment, you're not. And if you have an ISA, you're not. But, these are all things to consider. So if, say, for example, you happen to be on a 3% mortgage, it can make a big difference, I think, to pay that off. If it's under 1%, not so much, really. It's, you're better off looking at other things. But it could be part of what you do, because you don't have to do just one thing with your money. And in fact, I always say, don't just, I always say, spread your bets. Don't just put it all into one thing. But, as part of your consideration of where you could put your money, say you've got 10 grand saved, you think, well, I might put 2 grand into my mortgage. I mean, it all helps, and then I'll put more money elsewhere.
But you could make more, couldn't you? I mean, although it is a risk, putting it into an ISA, okay, maybe not a straightforward ISA, just which is paying you a steady rate of interest, which will almost certainly be lower than your mortgage. But if you put it into stocks and shares, I mean, based on past performance, which of course is no way to look at stocks and shares, but I mean, we're seeing the share market has been pretty elevated around the world, particularly in the United States, and that would certainly be giving you a better return right now than paying off your mortgage, wouldn't it? Particularly when I guess with interest rates being low, we're not seeing the devaluation effect of the mortgage happening too much at the moment either.
Yeah, absolutely. And this is really the interesting thing is I've been saying this for years, and mostly people go, yeah, and don't listen. Now. I'm
listening. We're all on the edge of our seats right now.
Of course you are. But yes, right now, for the first time in my lifetime, as far as I can see, well, maybe first time since the end of the 90s, people are starting to be really interested in investing, and particularly millennials and Gen Zers. But actually, people of all ages, they're going, Jasmine, you know that thing you were saying about investing? Yeah, could you say it again? What I do say to people is that there are two words here: there's saving and there's investing. They're different words because they mean different things. And when I do these money courses, investing courses, I do webinars. You can find them on Money Magpie. And one of the big things I get people really thinking, what is the fundamental difference between saving and investing? And the answer is time. So time is the big difference between saving and investing. Saving is short term, investing is long term. So what I say to people, if they've got a lump of money, as you say, firstly I say pay off your debts, pay off expensive debts. If you've got credit cards, etc., pay that off. And then put some money aside into savings. For particularly, you need at least 6 months worth of money set aside to be your savings safety net. And that should go into a nice, easy access account, which you do not touch unless everything goes pear-shaped, because that's what it's there for. It's there in case everything goes pear-shaped. And you might have some other things you might like to save for Christmas, a holiday. And again, you'd find the best rates that you can find, which is 0% of nothing really at the moment. But the rest of it, then that goes into your future. So for your future, you have to put that money into something that's going to give you a decent return, because you are going to have to beat inflation over the long term. Short term, inflation doesn't matter too much. I mean, it's depressing putting your money into a savings account that gives you 0.5% or whatever, but it's not the end of the world for 2 or 3 years or 5 years, up to 5 years. But for the long term, you have to put it into really the stock market. You can put it into bonds. Those are bonds, as you know, are loans to companies and to governments. The ones to governments are called gilts. But for the best really should be a mixture of stocks and shares and some bonds. And stocks and shares, are really, as you say, where the cash is going to come into. Those are the ones that, on the whole, on average, if you leave it there for long enough, you will beat inflation and you will make money on top of it.
Well, you will really, based on the last year, you will really beat inflation. But of course, the question is inflation, which I know a lot of people in the money markets are asking whether inflation is going to come back in a couple of years, because so much government money so many government bonds have been issued. There's so much new money in the economy. Is that going to push inflation rates up over the next couple of years, which will make it harder? So I guess strike while the iron's hot. Yeah. And so stocks and shares, ISAs, that sort of thing would be the way to do that?
Yes. I mean, I personally have never opened a cash ISA, because to me it's a waste of good tax saving. I have always opened stocks and shares ISAs, also known as equities ISAs, because an ISA, the point of ISAs originally, and as you know, they're called individual savings account. I mean, what does that say? But the point of them originally was to be as an extra to your pension. So they've always been there really for the long term. And, in the long term, it's only stocks and shares, only equities that really work. And what I always say to people is use your ISA allowance as much as possible. So you're given up to £20,000, which is a lot of money for a lot of people.
Yeah, per year. Yeah, exactly. Yeah.
So per tax year, so from April the 6th to April the 5th, you can put up to £20,000 into an ISA wrapped investment. And that can be, you just basically, you have a look on see what stock market fund or item you want to buy in the stock market. And you then have it wrapped in an ISA. A lot of funds are already, if you like, wrapped in an ISA, because the ISA element isn't an investment in itself. It's like a tax wrapper. That it's like going into a shop and buying a pair of trousers, and they put it into a bag to protect it from the wind and rain. Well, the ISA is the bag. The investment, is the trousers.
I love your analogies. All right. But it's a tax, because you're paying for it in after-tax dollars, pounds, I should say. I live in the UK now. I've been here for 6 years. I should know by now. So because you're paying in after-tax pounds, then the benefit of this is that you don't get taxed on the capital gains from this, which could be quite considerable. So that's the benefit, which is pretty much the same as putting money into a pension fund. So if you're a certain age, is there much difference between putting money into stocks and shares ISAs or putting it into a pension fund, which is also investing in stocks and shares?
Very good point. And this is a debate that's been raging since ISAs started, really, because the ideal, I would say, would be to have a bit in both. I'm always saying, don't put all your eggs in one basket, spread your bets. And there are advantages and disadvantages to both. So as you say, with ISAs, you put in money that is after tax, and it's when you take the money out later on that you don't have to pay tax on that. With pensions, the brilliant thing about pensions is that when you put money into a pension, the government adds the tax you would have paid on that up to a certain level. And again, with pensions, you can put up to £40,000 per tax year. That really means, if you're on ordinary tax, it means 32,000 a year, and then the government adds in the extra £8,000 that the tax that you would have paid on that money. So, as you say, the vast majority of pension funds are in stocks and shares. Again, they'll probably have a bit of a mix. There'll be stocks and shares and some bonds and maybe some property, and I don't know, but it will be very largely stocks and shares. So with pensions, there are a lot of advantages also. With an ISA, you can take the money out at any point, which is great. That's flexible. But if you're the sort of person who think, actually, I might just take it out and spend it, then you're better off really putting it in a pension, because you can't touch it until you're 55. and that actually protects your future self. When you're 55 or over, you could take it out in bits and actually avoid some tax, which is, again, that was brought in recently by a recent government. So whereas before pensions were quite inflexible, and you had to buy an annuity when you came out, which is it's a type of insurance product that's a fixed amount. Now you can kind of pretty much do what you like with it, and you can actually avoid.
So you can pull it out for whatever level is going to minimise your tax for that year.
Exactly, up to a certain amount. You can take the whole lot out, but you'll pay a load of tax on it. So if you do it sort of gradually, then you're not going to so much. So. Yeah, there are.
Talking about pensions, I mean, and this wouldn't be an issue for most people, but I was surprised to learn, as somebody who's so I have been out of the country for 25 years, but I was paying into the state pension, and then came back and started paying it again through my national insurance payments. And discovered actually I can go back and back pay. So you've got to have made 35 years of national insurance payments before you to qualify for a full state pension. And if I'm sort of thinking I'm planning that I'm going to work till 70.
Yeah. Why not?
And why not? Because I enjoy what I do. And so I'll be paying national insurance to that point. At that point, I will have paid 31 years of payments. So, but I can go back and pay, even though I wasn't in the country, I can go back onto the government's website and pay back the extra years so that I mean, if you've been out of the country for a while, that's an obvious thing to do as well. Spend a bit of money making sure that you get your full state pension.
Oh, that's interesting, because if you haven't left the country and you for whatever reason you haven't paid certain years of national insurance, you can pay up to the last 6 years.
Yeah, so same deal. Yeah, exactly. But even if you went in the country, you can still pay those 6 years.
That's good.
So at least I think that's the case. Giving me that option anyway on the website. So maybe we should just do it and not ask too many questions. So do you think, just final question then, do you think people will go back to and we're only talking about the proportion of the population who've done okay out of this thing because they've carried on working, they're working from home, and they're spending less. Do you think those people will be more cautious now? Now we've seen what it's like perhaps to have a bit more money and a bit more of a buffer than we had before. Do you think we might spend a little less recklessly and change our behaviour?
Certainly some people will, absolutely. And again, this is sort of divided people into all sorts of different camps. I think there will be people who will never go out the front door again, honestly. There will be a few people like that. There will be others, and I'm thinking particularly, so again, Gen Zers and millennials who will go bananas. They will go to every party, etc. But I think a lot of people that I've been speaking to, and certainly I've seen columns on this, they're saying, actually, I've realised I don't need all these clothes. I'm actually quite happy I'm doing this. Yeah. And I think a lot of people will think, actually, I'm going to put more money aside. I'm going to be a bit more sensible. And also, as I was saying before, there will be people who will be thinking, right, and I've seen them coming to my courses. I want to invest. I want to be sensible with my money. I want to create money for the future because I realise that it's up to me now. So, yeah, definitely. I think we're a lot of us will be a bit more sober, I think.
For a while. Anyway, look, until I'm not sober, I better get my money into those stocks and shares ISAs and a bit more into my pension before I do go out and not be sober. But stop that happening. Look, it's been great to talk, Jasmine. I hope I get you on the podcast again sometime soon. Thanks
definitely. For your time. It'd be great. Thank you so much for having me on, Phil.
So there's a cheery voice, isn't it? There we are. Now, finally today, just to round this week off, wokedom is winning.
3 life lessons with Mr. Potato Head. Put on a smile. Lend a helping hand. Love every part of you, each sold separately.
Yes, you thought Mr. Potato Head was alive and well and living with Mrs. Potato Head in the Toy Story movies. I'm not sure. What are we up to now? Must be Toy Story 26 by now, isn't it? But no, it's not Mr. Potato Head anymore. He's gone gender neutral. Well, he always was sort of gender neutral. I mean, he was never anatomically correct, was it? I mean, you couldn't buy the bits to stick onto him that would make him specifically Mr. Potato Head. If you see what I mean. But after 70 years, Hasbro, the makers of Mr. Potato Head, have decided he is now just Potato Head. Has the world gone mad? I think so. Look, we're talking stocks and shares on Monday morning. Rodney Hobson will be giving us a handful of shares to keep an eye on. And next week, this is going to be worth keeping an eye on as well. Donald Trump's tax records have now been submitted to the Manhattan District Attorney's Office. There's a story waiting to unfold. Try not to enjoy it too much, will you? Have a great weekend. Back on Monday. See you then.
It's the Business with Phil Dobbie. Listen online at itsthebusiness or wherever good